Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden deep within companies' financial reports. And trust me, the latest filing from Stellar Bancorp Incorporated is packed with some interesting pages that we're going to unpack for you today. So Stellar Bancorp Incorporated, known by its ticker symbol STEL, just dropped its quarterly report for the period ending the 30th of September 2025, and it paints a picture of a company navigating a changing financial landscape. We're going to dive into the numbers, see where the money's coming from, where it is going, and what it means for the future. Stick around, you won't want to miss this. And hey, if you love getting these insights straight from the source, make sure you are subscribed and hit that notification bell. For even more exclusive content and to join our community of financial sleuths, check out our Discord server linked in the description below. Alright, let's get straight to the core of it, the financial statements. These are the heart of any company's report, and Stellar's is no different. Looking at their balance sheet as of the 30th of September 2025, we see total assets are just over $10.6 billion. That is a slight dip from December 2024 when it was closer to $10.9 billion. On the flip side, their total liabilities have also decreased a bit, which is generally a good sign. Now, let's talk loans. This is where banks make a big chunk of their money. Stellar had about $7.17 billion in loans held for investment at the end of September 2025. That is down from $7.44 billion at the end of 2024. This decrease suggests they might be either less aggressive in lending, or perhaps some older loans have been paid off or written down. And importantly, their allowance for credit losses on loans stood at $78.9 million in September 2025, down from $81 million at the end of 2024. This allowance is like a rainy day fund for bad loans, so a decrease here could mean they feel more confident about their borrowers paying back their debts. Moving over to the income statement, net interest income after provision for credit losses for the 3 months ending the 30th of September 2025 was just over $100 million. This is slightly down from about $107 million in the same period last year. This narrowing of the gap between what they earn and what they pay out on interest is a key indicator of a bank's health. Interestingly, the provision for credit losses went from a reversal of $5.9 million in 2024 to a provision of $305,000 in 2025 for the 3-month period. This shift shows a more cautious approach to potential loan losses in the recent quarter. For the 9-month period, they had a provision of $5 million in 2025 compared to a reversal of $3.8 million in 2024. This definitely shows they are setting aside more money for potential issues. Non-interest income, which includes things like service charges and fees, was $5 million for the third quarter of 2025. That is a decrease from $6.3 million in the same quarter of 2024. This dip is partly due to a loss on the sale of assets, which can happen, but it is still something to watch. The 9-month comparison shows a similar trend, with non-interest income down from $18 million to $16.3 million. When we look at non-interest expenses, they were $73.1 million for the quarter ending the 30th of September 2025, slightly up from $71 million a year earlier. A big chunk of this is salaries and employee benefits, which went up by about $2 million for the quarter, the 9-month figures also show this slight increase in overall expenses. Specifically, salaries and employee benefits saw an increase. This could be due to hiring more staff or perhaps annual raises. For the 9 months ending the 30th of September 2025, this category alone jumped by about $4.3 million. It is important to see if this increase in staffing or compensation is translating into higher revenue or efficiency. On the flip side, amortization of intangibles decreased by $658,000 for the quarter and about $2 million for the 9 months. Intangible assets like goodwill from past acquisitions get written down over time, so this decrease is a normal part of the business cycle. Let's talk about the core banking business. Their net interest income and margin on a tax equivalent basis was 4.20% for the quarter ending the 30th of September 2025. This is a tiny increase from 4.19% in the same period last year. This metric is super important. It basically tells you how much profit they are making on the difference between the interest they earn and the interest they pay out. A stable or slightly increasing net interest margin is a sign of good management in a fluctuating interest rate environment. For the 9-month period, the margin slightly decreased to 4.19% from 4.23% in the prior year. Now, looking at the loan portfolio itself, the average balance of loans decreased by about $506 million for the 9 months ending the 30th of September 2025 compared to the prior year. This is a significant drop, suggesting either a deliberate strategy to reduce loan exposure or perhaps weaker demand for loans. The allowance for credit losses on loans as a percentage of total loans is 1.10% as of the 30th of September 2025. This is slightly up from 1.09% at the end of 2024. While still relatively low, an increase here means they are setting aside a bit more for potential loan defaults. Now, let's zoom out to asset quality. Non-performing assets, which are loans that are not generating income, stood at 0.51% of total assets in September 2025. This is up from 0.36% at the end of 2024. This increase in non-performing assets, especially in the commercial real estate sector, is definitely something to monitor closely. Specifically, total non-accrual loans increased from about $37 million at the end of 2024 to $46 million. By September 2025, a rise in non-accrual loans is a red flag for potential future losses. The commercial real estate construction and land development portfolio saw a noticeable decrease, dropping by about 10.9% to $753 million from $845 million. This is a significant reduction, perhaps reflecting a cautious approach to this sector given current economic conditions. Their investment portfolio, classified as available for sale, is quite substantial. At the 30th of September 2025, the carrying amount was $1.84 billion, up from $1.67 billion at the end of 2024. This growth in investments could be a strategic move to diversify income streams or park excess liquidity. Within their securities portfolio, a big part is in US government and agency securities, totaling $175 million at fair value. They also have significant holdings in municipal securities and agency mortgage-backed securities. However, within these investments, they reported gross unrealized losses of $108 million for available for sale securities in September 2025. This means the market value of some of their investments has fallen below what they paid for them. These are largely driven by interest rate changes, not necessarily credit quality issues, but it does impact their reported equity. Now, onto deposits, the lifeblood of any bank. Total deposits at the 30th of September 2025 were $8.82 billion, a decrease from $9.13 billion at the end of 2024. The non-interest bearing deposits, which are the cheapest form of funding for a bank, also saw a significant drop. This could indicate either customers moving money to higher yield accounts elsewhere or strategizing to manage their cash differently. Looking at their borrowings, they have junior subordinated debentures totaling $11.3 million and other subordinated notes. These are essentially long-term debts that help bolster their capital. On the 1st of October 2025, right after the reporting period, they redeemed $30 million of these notes, which is a significant financial move. In terms of capital strength, Stellar Bancorp, incorporated as a consolidated entity, maintains strong capital ratios. Their total capital to risk-weighted assets ratio was 16.33% in September 2025, well above the minimum required, so from a regulatory standpoint, they seem to be in good shape. Now, let's shift to market risk, specifically interest rate sensitivity. The tables here show how changes in interest rates could impact their net interest income and the economic value of their equity. For instance, a 100 basis point increase in interest rates could lead to a 2.9% increase in net interest income over a 12-month horizon. Generally, they seem fairly well positioned to handle moderate rate hikes, but larger shifts do present some risk, especially to the economic value of their equity, which could see a more significant drop. On the legal and governance side, we can quickly see that there haven't been major changes in risk factors. However, they did mention a new share repurchase program for up to $65 million through May 2026. This shows a commitment to returning capital to shareholders, which is usually a positive sign, assuming it is done at a sensible price. And a key subsequent event to note, right after the quarter ended, they redeemed $30 million of their subordinated notes. This will definitely impact their interest expenses going forward and shows active capital management. So, what is the story here? Stellar Bancorp Incorporated appears to be a solid, well-capitalized bank, especially from a regulatory perspective. They are managing their balance sheet, albeit with a slight decrease in loan volume and an increase in non-accrual assets which warrant attention. The dip in non-interest income and the rise in expenses are areas to watch, but the core net interest margin remains stable, which is a testament to their operational management. Their significant investment in securities, coupled with the slight unrealized losses, reflects the current market interest rate environment. The reduction in commercial real estate construction loans suggests a prudent move given the sector's current challenges. Overall, Stellar seems to be navigating a complex economic period with a focus on capital preservation and shareholder returns, as evidenced by their share repurchase program and proactive debt management. What is your take on Stellar Bancorp's recent performance and their strategic moves? Are they positioned for growth or hunkering down for tougher times? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate finance. And of course, join our growing community on Discord, linked in the description. And we'll see you next time.